big a correction are we going to have? So let me start with the charts real quick, and then I'll go to my summary. This is the chart of the drawdown of the S&P since March 23rd. That was the low day. The biggest correction that the S&P has had to date is been last week. It's essentially equal to what we saw in June. Intraday, it was actually larger. If you look at the NASDAQ, it far and away has had the largest correction to date since the March 23rd low. So that's what I'm referring to, is that we have had in the stock market the largest correction so far that we've seen since March. So let me go back to my headlines. What's going on here and what more should we expect of it? And I'm going to tie in the bond market and a couple of other things. The Fed has responded to the pandemic by printing money. This action has squashed interest rates and rate volatility. The bond market is asleep. I've got a series of slides. It was yesterday's news clips feature that I'll go through as well too. And this action has been encouraging speculation. That's why, for those of you, remember back in March and April, I said the market was going down. Then I thought there would be a retest. And then in late May to early June, I said, okay, I don't think there's going to be a retest. We're going to make a run at the highs. That was 3 months ago, because of this encouragement of speculation. And now it's grown to the point where the option market is out of control because the Fed has your back. Davey day trader Dave Portnoy may not understand the nuances, but he gets the bigger picture. Rule 1, according to Davey day trader, stocks always go up. Rule 2, when in doubt, remember rule 1. He doesn't have to understand the nuances of quantitative easing or of any of the other things that the Federal Reserve is doing with forward guidance or government stimulus, but he does know that the might and will of the Federal Reserve and the might and will of the federal government will not let the stock market go down. So go ahead and speculate with reckless abandon, and that has led to bubbly valuations. I'll say this up front. When I go through the speculation numbers and the valuation numbers, the conclusion would be, oh God, this is the biggest sell since 2000 or maybe February, and that the market is in deep trouble. And that's not an incorrect statement. But I'm only thinking about a 10 to 15% correction because the Fed is not going to go down without a fight. They have a very big printing press. And yesterday, Powell kind of hinted at that. The joke about yesterday was they said that they're going to let inflation run hot. They're going to keep interest rates at 0 for 3 years, that they don't need to have another Fed meeting now until 2023 because there's nothing more to be said at any of the other Fed meetings. They're all in. They're at 0. They don't care about inflation. They are focused on unemployment. They want that down, and they will tolerate a little bit more inflation. So what's to discuss at the next meeting? Paul was asked that exact question, and he said, oh, look, we could expand the balance sheet. We could do more forward guidance. We could basically help prop up the market. And then he was asked if there was a bubble, and he said he saw no evidence of a bubble as well, too. So let me dig into some of these charts. Let's talk about the speculation in the market. And the speculation in the market as a top line here is coming from retail traders. It's coming out of the options market. So, I know there's a lot there. The US market is unique to developed world markets in that it is dominated by institutional investors. Every other market, the largest share of trading, European markets, Japanese markets, South Korean, I'm talking about major developed markets, if you will, the largest share of trading comes from retail investors, except for the US market. Largest share of trading comes from institutional investors. So we always try to defer to, these explanations of what's going on in the market, Gamma Book and SoftBank's options trade, and something that needs to be explained to you 9 times and you stand on your head and you still don't understand it. Oh, that has to be the reason, because it's a sophisticated institutional market. In this case, it's as simple as rule 1, stocks always go up. Rule 2, never forget rule 1, find yourself the most amount of leverage. There is no such thing as a reckless bet. Go. And that seems to be what's happening in the market, and it's coming largely out of the options market. So the first chart on page 5 here, slide 5, is the ratio of options trading volume to stock trading volume.